In January of this year, President Trump announced he was calling for a 10% cap on credit card interest rates. Most people heard that and thought, finally, some relief. Here is what they didn't hear. Within 48 hours of that announcement, the banking industry released a study that found if that 10% cap goes into effect, card issuers would be forced to close accounts for nearly 90% of current cardholders. That is 175 million Americans who would lose access to their credit cards. Not people who missed payments, not people who went bankrupt. People who paid on time every time for years, who would wake up one morning and find their card declined at the grocery store because a Washington policy decision made them unprofitable to serve. Now, that bill has not passed. The cap is not law yet. Congress is still fighting about it, and I am going to explain exactly where it stands in this video. But here is why I needed to get this video out right now. The threat to your credit card is not just this one bill. There are three separate forces moving through the credit market right now, simultaneously, that put retirees on fixed incomes at greater risk of losing their credit access than almost any other group in America. And the moves that protect you cost nothing, take less than an hour, and almost nobody is making them. I have watched retirees lose a credit card they have had for 20 years. A card with a perfect payment history, a card they never abused, and not understand why it happened, not understand what they could have done to prevent it, and not know what to do next. That is what this video is for. This video is for educational purposes only, and is not financial advice. Consult a qualified financial professional before making any decisions about your specific situation. My name is Kevin, and every week I break down the financial rules, the traps, and the strategies that protect retirees from things nobody else is explaining. If that sounds like something you need, subscribe right now and turn on notifications. Let's get into it. Let me lay out exactly what is going on in the credit card market in 2026, because there are three separate things happening at once, and most people only know about one of them. Threat 1. The 10% interest rate cap proposal. On January 9th, 2026, President Trump posted on Truth Social calling for a one-year cap on credit card interest rates at 10%. He framed it as protecting Americans from being ripped off by credit card companies, which are currently charging an average of nearly 24% APR, the highest rates in modern history. The idea has bipartisan support. Senators Bernie Sanders and Josh Hawley introduced legislation to cap rates at 10% for 5 years. A similar bill has been introduced in the House. The banking industry's response was immediate and alarming. JP Morgan Chase's CFO said the bank would have to significantly cut back its entire card business. Bank of America's COO said the math of lending simply stops working at a 10% cap. And the Electronic Payments Coalition released the study I mentioned, finding that accounts for 175 million Americans would need to be closed, because at 10%, the lenders cannot price for the risk of lending to most borrowers. That study specifically found that most accounts with credit scores below 740 would be shut. Let me say that again clearly. A credit score of 740 is considered good. It is not subprime. It is not bad credit. It is a respectable score that most Americans would be proud of. And it would not be good enough to keep a credit card if this cap passes. As of today, the cap is not law. The bill is stalled. Trump's post was not an executive order and carries no legal force on its own. Congress would need to pass legislation, or regulators would need to act, for this to take effect. But the uncertainty alone is already changing how banks think about their credit card portfolios. Threat 2. Tightening underwriting standards. Separate from the rate cap proposal, Banks have been quietly tightening who they will extend credit to since 2023. Credit card delinquency rates have been climbing. Americans now owe a record $1.23 trillion in credit card balances. Banks are getting burned on defaults, especially in the lower and middle credit tiers. Their response is predictable. Raise the bar for who gets approved, reduce limits for existing customers who look riskier, and quietly close accounts that are costing more to service than they are generating in revenue. This is happening right now, with or without any new legislation. And retirees are disproportionately exposed, not because of bad behavior, but because of how their income looks on paper, which I will explain in detail in a moment. Threat 3. Inactivity-based closures. This is the one that surprises people most. Card issuers have always had the right to close accounts that are not being used. If your card sits in a drawer generating no revenue for the bank, they have zero incentive to maintain that credit line. In a tighter lending environment, banks are accelerating this practice. Cards that haven't been used in 12 to 18 months are increasingly at risk of automatic closure. And here is why this matters specifically for retirees. Many retirees have older cards with long histories and high credit limits, that they keep for emergencies but don't use regularly. Those cards are the most valuable ones they own from a credit score perspective. A card with a 20-year history and a $15,000 limit is anchoring their credit profile in ways they don't fully appreciate. And it is precisely those cards that are most at risk of quiet closure. 3 threats, happening simultaneously. Most retirees don't know any of them are coming. Now let me explain why this hits retirees harder than almost anyone else. When you were working, your income situation was simple. You had a W-2. Your employer sent it to the IRS. When you applied for credit, you wrote down your salary and the bank verified it easily. The moment you retire, that changes completely. Your income is now a combination of Social Security, pension payments, IRA or 401k withdrawals, investment income, maybe some part-time work. Some of it is monthly. Some of it is irregular. Some of it doesn't show up on a standard income verification the way a salary does. Card issuers periodically review their existing customers' income. They ask cardholders to update their income information. Or they pull data from credit bureaus that estimate income based on spending patterns and public records. And here is where retirees fall into the trap. A retired teacher earning $52,000 a year from a combination of Social Security, a pension, and modest IRA withdrawals has a perfectly adequate stable income. But when a bank's automated system looks at her profile and sees no W-2 income, irregular deposit patterns, and an income figure that is lower than it was 5 years ago, the algorithm may flag her as higher risk, regardless of her payment history, regardless of her savings, regardless of the fact that she has never missed a payment in her life. The system is not evaluating her actual financial stability. It is pattern matching against the model built around working-age income profiles, and she doesn't fit the pattern. Meet Margaret, 69 years old, retired school librarian, has a Visa credit card she has held for 21 years, never missed a payment, keeps the balance paid in full every month. Credit score of 778. Last spring, her card issuer sent her a notice, buried in the fine print of a routine communication, saying they were reducing her credit limit from $18,000 to $4,500 due to a periodic account review. She had not changed her behavior. She had not missed a payment. She had not spent more than usual. What had changed is that the bank re-evaluated her income when she updated her profile, and her retirement income reported correctly. came in lower than the system expected for a customer with an $18,000 limit. The limit reduction did two things. It reduced her credit availability for emergencies, and it dropped her credit score by 31 points overnight, because her credit utilization ratio, the percentage of available credit she was using, jumped from under 5% to over 20% on a single card. That 31-point drop put her at 747. Still good, but 7 points from the threshold at which banks start making different decisions. Nobody warned her. Nobody explained the trigger. The letter she received used language so generic that she assumed it was routine. It was not routine, and it was preventable. Let me give you the specific moves. These are not complicated. Every single one of them is available to you today. Move 1. Update your reported income correctly and completely. This is the most important thing I am going to tell you in this video. When a card issuer asks you to update your income information, most retirees underreport. They think of income as their monthly Social Security check plus maybe their pension. They do not think of IRA withdrawals as income. They do not think of investment dividends as income. They do not think of a spouse's income as something they can count. Under the 2009 Credit Card Act, amended in 2013, applicants and existing cardholders aged 21 and older can report any income they have reasonable expectation of access to. That means your full Social Security benefit counts, your pension counts, your regular IRA withdrawals count, interest and dividends from investment accounts count. If your spouse is still working, their income counts. If family members help support your living expenses, that can count. The retiree who reports only her $1,800 monthly Social Security check as $21,600 in annual income is telling the bank a fraction of the truth. The retiree who correctly reports her $21,600 Social Security plus $18,000 pension plus $12,000 in annual IRA withdrawals, plus $4,000 in dividends, totaling $55,600, is showing the bank a completely different financial picture. Same person, same money. Completely different credit profile. Log into each of your card accounts this week, find the Income Updates section, report every legitimate source. Do it now, before any review is triggered, so the bank's current file on you reflects your complete financial reality. Move 2. Use every card you want to keep. The simplest way to prevent inactivity-based closure is to use the card. You do not need to carry a balance. You do not need to spend a lot. A single small purchase every 60 to 90 days, a cup of coffee, a tank of gas, a prescription, is enough to show the bank that the account is active and generating interchange revenue. Go through your wallet and your saved cards right now. Identify every card you have not used in the past 3 months. Put one small recurring charge on each of them, a streaming subscription, a utility bill, anything, and set it to autopay so you never miss a payment and never accidentally let the card go dormant again. This takes 20 minutes. It protects the most valuable cards in your credit history. The old ones, the ones with high limits, the ones that are anchoring your credit score. From quiet closure. Move 3. Request a credit limit increase before any review is triggered. This sounds counterintuitive. If you're worried about banks pulling back, why would you ask for more credit? Because requesting a limit increase while your account is in good standing before any review flags your income as a concern puts you in a fundamentally different position. A proactive request gives you control over the timing and framing. You are the customer in good standing asking for more access. The bank reviews your current profile and either approves, giving you more cushion, or declines, in which case you are no better off than before, but you have not lost anything. A reactive situation, where the bank initiates the review and reduces your limit before you have a chance to update your income information, puts the bank in control and leaves you scrambling to respond to something that has already happened. Call the number on the back of each of your most important cards. Ask what the process is for requesting a limit increase. Ask whether they have current income information on file. Update it if they don't. Do this now, while you are a customer in good standing, not after they have already made a decision about your account. Move 4. Know your credit score and protect your utilization rate. Your credit utilization ratio, the percentage of your available credit that you are currently using, is one of the most powerful factors in your credit score. The general guideline is to keep it below 30% across all cards. Under 10% is even better. But here is what most people don't understand about how this works. Your utilization is calculated card by card, not just in total. If you have one card with a $5,000 limit and a $2,500 balance, that card is at 50% utilization. Even if every other card you own has a zero balance, that single card at 50% can drag your score down significantly. For retirees who use one card primarily for day-to-day spending and pay it off monthly, this is often not an issue. But for retirees who carry a balance on any card, even a modest one, understanding this math is critical. If a bank reduces your limit from $18,000 to $4,500, the way Margaret's bank did, and you have even a $1,000 balance on that card, your utilization on that card just jumped from 5.5% to 22% overnight, without you spending a single additional dollar. Check your utilization on every card right now. Annualcreditreport.com is free and federally mandated. You can check your full credit report at no cost. Know where you stand before a bank's decision changes it for you. Move 5. Build a cash buffer that makes credit optional, not essential. This is the long-term move, and it is the one that changes your relationship with credit cards permanently. The retirees who are most devastated by credit card closures or limit reductions are the ones who depend on their cards as a cash flow bridge between Social Security payments, as emergency coverage for unexpected medical bills, or as the primary tool for managing month-to-month expenses. When those cards disappear, the bridge disappears with them. Financial planners recommend retirees keep 3 to 6 months of essential expenses in a liquid, accessible account, a high-yield savings account, or a money market fund, separate from their regular checking account. I know that is not always possible on a fixed income. I know that for many retirees, building that buffer means years of small contributions. But even a $2,000 emergency cushion changes the math dramatically. It means a sudden credit limit reduction is an inconvenience, not a crisis. It means a card closure is a problem to solve, not a financial emergency that cascades into missed payments and score damage. Start where you can. Even $50 a month into a dedicated emergency fund moves you in the right direction. Let me address what happens if you are already in this situation. If a card has already been closed, or a limit has already been reduced, without warning. Step 1. Call the issuer the same day. Card issuers can reverse closures and limit reductions, but they typically will only do it within a narrow window, often 30 days or less. After that, the decision is usually final. When you call, do not lead with frustration. Lead with your history. Say exactly this: I have been a customer for X years. I have never missed a payment. I would like to request a review of this decision and provide updated income information. Then give them your complete income picture, using everything I described in Move 1. Some banks will reverse the decision on that call. Others will escalate it for review. Either way, you have a better chance calling immediately than waiting. Step 2, do not close other cards in response. This is a reflex many people have. If a card is reduced or closed, they get frustrated and close a second card in protest or consolidate to fewer cards. Do not do this. Every card you close reduces your available credit and shortens your average credit history. Both of those changes hurt your credit score, which makes you look worse to every other lender reviewing your profile. Keep every card open that you can. Use them all minimally. Let the history accumulate. Step 3. Rebuild utilization deliberately. If a limit reduction has spiked your utilization ratio, the fastest way to recover is to pay down the balance on the affected card as quickly as possible. Every dollar of balance you reduce on a high utilization card immediately improves your ratio and starts rebuilding your score. If cash is tight, prioritize paying down the card with the highest utilization first, not necessarily the one with the highest balance. Let me come back to where the 10% rate cap proposal actually stands today. As of right now, the bill has not passed. Trump's January 9th Truth Social post was a public call, not an executive order. He has not signed any legislation. The Hawley-Sanders bill in the Senate has bipartisan support, but has not moved to a floor vote. For the cap to become law in its current form, it would need to pass both chambers of Congress and be signed by the President. That is not imminent. What is possible, and what banks are already preparing for, is a softer version. A cap at 18% or even 20% would have far less dramatic consequences for credit availability than 10%, but would still force banks to tighten who they lend to. There is also the possibility of executive action through banking regulators, though that pathway is legally complicated and being challenged in courts. The honest answer is, nobody knows exactly what form this takes or when. The uncertainty itself is the problem. Banks do not wait for laws to pass before they start managing their risk. They read the political environment and start adjusting their portfolios in anticipation. The tightening I described in Threat 2 is already happening, driven in part by the assumption that some form of rate restriction is coming, which is exactly why the 5 moves I gave you matter right now, not later. The window to act proactively, to update your income, to activate dormant cards, to request limit increases from a position of strength, is open today. The window after a bank has already made a decision about your account is much narrower and much harder to work through. Let me bring it all together. 3 threats are converging on the credit card market right now. The proposed 10% interest rate cap that could force 175 million account closures, tightening bank underwriting standards, but disproportionately flag retirees whose income looks different on paper, and the quiet acceleration of inactivity-based card closures hitting the oldest and most valuable cards in your wallet. Retirees are the most exposed group, not because of bad financial behavior, but because of how retirement income is evaluated by automated banking systems that were built around W-2 earners. The 5 moves that protect you: update your reported income to include every legitimate source. Use every card you want to keep at least once every 60 to 90 days. Request credit limit increases proactively before any bank review is triggered. Know your utilization ratio on every individual card and build a cash buffer that makes credit optional rather than essential. If your card has already been reduced or closed, call the issuer the same day. Provide complete income information and do not close any other cards in response. The rate cap is not law yet, but the tightening is already happening. And retirees who wait to act until something has already gone wrong will find the options available to them much more limited than the options available to them today. Margaret, the retired librarian I told you about at the start, got her limit partially restored after calling her bank and providing complete income documentation. It took 2 phone calls and about 45 minutes. They restored it from $4,500 to $11,000. Not all the way back, but most of the way. She told me the worst part wasn't the limit reduction itself. The worst part was not knowing it was coming, not knowing what triggered it, and not knowing what she could have done differently. Now you know. If this video helped you, hit the like button right now. 1 second. It helps this reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell. The next video I am working on covers the Medicare premium surcharge that adds thousands to your annual costs based on a financial decision you made 2 years ago, and the form almost nobody files to fight it. You will not want to miss it. If you know a retiree who depends on their credit cards and has never thought about any of this, send them this video. The moves I described take less than an hour. The consequences of not making them can last years. Drop a comment. Has a card ever been closed or reduced on you without warning? Tell me what happened. I read every single one, and your experience might become the opening story of the next video. I'll see you in the next one.